Hello everyone, Alex Kim here. What we're looking at in silver right now is not a breakout narrative that will be validated by retrospective analysis. It's a structural repricing that's already underway, while the institutional conversation remains focused on whether silver can sustain triple-digit levels, rather than what happens when the system that prices monetary metals loses credibility. While gold held near $20 per ounce from 1789 to 1933 because governments anchored currencies to fixed gold weight, silver functioned as the companion monetary metal with comparable stability until that link was severed. When Roosevelt revalued gold to $35 in 1934, that wasn't a market move. It was a political acknowledgement that maintaining convertibility required fiscal discipline the system could no longer sustain, and silver lost its formal monetary role in that same process. The point is not that gold moved from 20 to 35 while silver was demonetized. The point is that once the anchor breaks, repricing doesn't stop at convenient levels, and silver's trajectory mirrors gold's but with amplified volatility due to its dual role as both monetary metal and industrial commodity. If monetary debasement can take gold from $20 to over $4,000, silver's move from historic lows toward triple digits and potentially four figures reflects the same fundamental driver: currency dilution, compounded by industrial demand that didn't exist when silver was purely monetary. The mathematical progression isn't speculative. It's the arithmetic consequence of continuing policies that debase fiat while silver supply remains constrained and industrial applications expand. You can debate timing, but the directionality is embedded in the structure, and silver's smaller market size means repricing happens faster and more violently than in gold. The dollar was originally defined in 1792 as a specific weight of gold or silver, meaning the currency wasn't separate from the metals, it was a claim on either one. The Spanish dollar, which the US dollar was modeled after, was a silver coin, and for over a century both gold and silver circulated as lawful money with fixed exchange ratios. Even after the Federal Reserve was created in 1913, paper dollars remained redeemable in either metal, depending on denomination and period. Americans used both gold and silver directly as currency, not just gold, and Federal Reserve notes functioned as substitutes backed by and convertible into metal. Silver's monetary role was diminished earlier than gold's, first through the crime of 1873, which demonetized silver domestically, then through gradual removal from coinage. But the metal remained in the monetary system in modified forms until the last silver certificates were discontinued. The structural break came when convertibility ended entirely, removing the final constraint on money printing. Without metal redemption as a check, central banks could expand balance sheets without immediate accountability, and the inflation that followed wasn't coincidental, it was structural. What we're seeing now in silver, even more than in gold, is the market beginning to price in the cumulative consequence of 5 decades of unchecked issuance, while simultaneously pricing in industrial demand that has made silver increasingly scarce relative to supply. Silver just broke out this year after forming a double top around $50 in 1980 and again in 2011, which means it consolidated for over 40 years before clearing that resistance. And the move through $100 then 117 marks a structural shift, not a momentum spike. Gold confirmed its breakout earlier, but silver's move is more significant from a positioning standpoint because it historically lags gold in repricing cycles. And now it's signaling that the broader monetary metals complex is entering an acceleration phase where industrial scarcity meets monetary demand. This isn't speculation, this is positioning. Foreign central banks have been aggressively accumulating gold and reducing dollar exposure, but they cannot accumulate silver at scale the way they do gold, because the silver market is far smaller and a significant portion of annual production is immediately consumed by industrial applications that cannot be deferred. That asymmetry means silver's repricing happens through private accumulation and industrial hoarding rather than official reserve buying, and the flows are less visible but equally structural. The distinction between money and currency is central to understanding what's happening, and silver's historical role makes this particularly clear. Currency is a medium of exchange that can be backed by money, which is the underlying store of value. When the US operated on a bimetallic standard, paper dollars were currency, and both gold and silver were money, with silver often more present in daily transactions due to its lower denomination. The paper functioned as a money substitute, a claim on something with intrinsic value. There are two kinds of currency: legitimate currency backed by real money and fiat currency backed by nothing except confidence in the issuing authority. What we have now is fiat currency, and the question being tested in real time is whether that confidence can be sustained indefinitely or whether the system eventually reverts to something with intrinsic backing. Silver's unique position is that it never fully lost its monetary properties even as it was demonetized, and it simultaneously became indispensable industrially in ways that create supply constraints gold doesn't face. The argument that Bitcoin or other crypto assets can replace silver or gold as a monetary anchor doesn't hold up under structural analysis, but it's particularly weak when applied to silver because silver has proven industrial utility that creates baseline demand independent of monetary sentiment. Bitcoin has appeal as a speculative asset, but it lacks the properties required to function as a reserve or as backing for a currency system. And more importantly, it cannot serve the industrial functions that give silver dual support. Central banks cannot hold Bitcoin as a reserve against their own currency, because if they needed to liquidate in size, the price would collapse, which is exactly the opposite of what a reserve asset is supposed to do. Silver, by contrast, has both monetary history and industrial necessity, meaning demand exists independent of sentiment. A reserve must be liquid, stable, and hold value under stress, and Bitcoin fails that test when measured against real money, while silver passes it due to intrinsic utility. The fact that some sovereign wealth funds or smaller nations like El Salvador have taken allocations into Bitcoin or Bitcoin-related instruments doesn't indicate monetary adoption. It indicates portfolio managers under performance pressure making tactical bets in a rising market. That's not the same as structural accumulation, and the distinction matters because when the cycle turns, those positions become exits, not anchors. The gold to Bitcoin ratio has been telling this story clearly, and the silver to Bitcoin ratio is even more revealing. Bitcoin's high watermark was 4 years ago, and it's down roughly 40% against gold since then, meaning that measured in real money rather than fiat, Bitcoin has been distributing from early accumulators to retail buyers at elevated prices. Against silver, which was undervalued during that period, Bitcoin's relative performance is worse. That's not a monetary asset gaining trust. That's a speculative asset changing hands. Watch the flow, not the headlines. The flows into gold from central banks reflect structural reserve shifts, but the flows into silver reflect something different. They reflect private sector positioning by entities that understand silver's scarcity and dual role. And those flows are harder to track, but equally telling. This isn't about predicting a collapse date. It's about recognizing that the incentives to debase currency remain in place while the consequences of that debasement are now compounding faster than the system can manage. Are you tracking how silver's industrial demand is intersecting with its monetary repricing in ways that create tighter supply constraints than gold faces? If this type of structural analysis is useful, consider subscribing so you can follow how these positioning signals develop in the silver market over the longer cycle. The narrative that crypto can replace monetary metals rests on the assumption that technology can substitute for intrinsic value. But history shows that during periods of monetary stress, markets revert to assets that don't require trust in a counterparty, an issuer, or a network. Silver, like gold, doesn't decay, it doesn't default, and it doesn't depend on infrastructure. But unlike gold, it also has industrial applications that create constant physical demand. A ship that sank 500 years ago can be salvaged today, and if there was silver aboard, it looks exactly the same as it did when the ship went down. And that silver can be immediately used in industrial processes that require its unique conductive and reflective properties. That's not just a physical property, it's a monetary and economic property, because it means silver holds value across time without degradation, while also maintaining utility that creates baseline demand independent of sentiment. Blockchain technology and tokenization may modernize how metals are transferred or settled, but they don't replace the underlying asset or create the industrial necessity that silver uniquely possesses. Stablecoins are tokenized dollars, which means they're still fiat claims wrapped in new technology. The technology doesn't change the fact that the claim is on an asset being debased, and it doesn't create physical utility. Silver remains anchored both as money and as an irreplaceable industrial input, because it exists outside the system that's trying to stabilize itself with more issuance while simultaneously being consumed in technologies that cannot substitute alternatives. As confidence in currency erodes, silver's dual role as money and industrial commodity becomes not just relevant, but unavoidable. And that's what's being priced now in ways that haven't been fully recognized yet. The move from double-digit silver toward triple digits and potentially four-figure silver is not extreme when you consider that the monetary base, debt levels, and unfunded liabilities are all multiples of where they were historically, while silver's above-ground available supply has actually decreased due to industrial consumption that doesn't return metal to the market. The repricing isn't speculative, it's compensatory for both monetary debasement and physical scarcity. The system is still addicted to debt expansion, and every cycle of intervention requires more liquidity, which means more dilution, which means silver continues to reprice upward in fiat terms while simultaneously being consumed in applications from solar panels to electronics to military systems. The question isn't whether silver can reach three-figure or four-figure prices. The question is what the purchasing power of the dollar looks like when silver reaches those levels, whether that represents real appreciation or simply reflection of further debasement, and how industrial users respond when they realize procurement at any price becomes necessary. Silver's smaller market size compared to gold means repricing happens faster and with more volatility, and the industrial demand floor means price cannot collapse the way purely monetary assets can because there's constant physical offtake regardless of sentiment. The public narrative lags the positioning. Central banks have shifted behavior in gold, buying physical and reducing dollars, and that's visible in official data, but silver positioning is less transparent because it happens through private accumulation, industrial stockpiling, and derivative positioning by entities that understand supply constraints. Retail participants and commentary are still debating whether silver is overextended after breaking $100, but the entities that manage industrial procurement and large private portfolios have already moved. That gap between narrative and positioning is where these structural moves become visible before they're widely understood, and it's particularly pronounced in silver because the market is smaller, less liquid, and more opaque than gold. This is not a retail story. The institutions managing exposure aren't buying silver to speculate on price. They're securing physical supply because they understand that industrial demand is inelastic, and monetary demand is re-emerging simultaneously, creating a supply situation that cannot be resolved through price alone in the near term. Going back further, neither gold nor silver was the first form of money. They were the solutions to problems that earlier forms of money couldn't solve. Before money, societies relied on barter, which required a coincidence of wants. If you're a butcher and I'm a baker, we can trade meat for bread. But if you're a vegetarian, the trade doesn't work. Money solved that by providing a universally accepted medium of exchange, but early forms of money like livestock, salt, or shells had limitations. They were either perishable, difficult to transport, hard to divide, or lacked scarcity. Gold and silver emerged as the best money because they met every requirement simultaneously. They were durable, divisible, portable, scarce, and universally accepted. You could verify the weight and purity of coins made from either metal and neither spoiled or degraded, which meant they preserved value across time and geography. Silver often circulated more than gold in daily commerce because its lower value per unit made it practical for smaller transactions, which is why silver coins were more common in everyday use, while gold was reserved for larger settlements and store of value. That's why both metals displaced alternatives across civilizations that had no contact with each other. The logic was universal. The monetary role of gold and silver wasn't imposed by governments, it was discovered through market processes, and governments later anchored their currencies to them because the public already trusted them. Modern fiat systems reversed that relationship. They detached currency from metal and replaced intrinsic value with policy credibility. That works as long as the credibility holds, but when it erodes, the system reverts to what worked before, which is why silver is repricing now alongside gold, but with greater volatility due to its smaller market and industrial constraints. This isn't a new phenomenon. It's a very old pattern reasserting itself. The same economic problem that led societies to adopt silver and gold thousands of years ago, the need for a stable store of value that doesn't depend on trust in an issuer, is being re-encountered today as fiat currencies face structural debasement. The difference now is that we have historical data showing what happens when governments prioritize short-term flexibility over long-term monetary stability. And that data consistently points to precious metals reasserting their monetary role. But silver's situation is distinct from gold's because it carries industrial demand that has grown exponentially since demonetization, creating supply constraints that gold doesn't face. Solar energy alone consumes significant annual silver production. Electronics require it for conductivity, military applications depend on it, and medical uses create additional baseline demand. None of this demand is price-sensitive in the way speculative demand is, which means industrial users must procure silver regardless of price once inventories deplete. The current moment is not an endpoint. It's an early structural phase where the market is beginning to price in the reality that money detached from intrinsic value eventually fails, and that the fundamentals that made silver essential money historically are still relevant today, now compounded by industrial necessity that cannot be substituted. What part of silver's dual role as monetary metal and industrial commodity do you think the market is still underestimating? This is a long-term, structural shift driven by both monetary debasement and physical scarcity, not a cyclical rally. And understanding the distinction between speculative moves and fundamental supply-demand imbalances will matter as this develops further over the coming years.